Good morning, everyone. I'd like to call the meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Inuit, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Brent McIntyre, and I'll be chairing the panel today. And to my left is Carrie Linklater, and to her left is Ian Mann. Our assessor for today is Kim Wong, and our recording secretary is Belhen Rojo. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of property are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the Board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the Board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed, with each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all of the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the Board will deliberate in private and make its decisions. You will receive the Board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We will be hearing items 1 through 7 on our docket today. Mr. Rojo, please affirm the assessors and the applicant's testimony. Thank you.
Mr. Assessor, please state your full name.
Kim Wong.
And you affirm the evidence you about to present is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Mr. Applicant, please state your full name.
Rocky Uco.
And you affirm the evidence you about to present is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Thank you very much. The first property on the docket today is 835 Sterling Line Parkway. And to both the applicant and the assessor, are there any preliminary issues with this property?
I think so. I think the applicant mailed some rebuttal information to the board and to me this morning, but I was looking over the rebuttal information and I'm not sure if it's rebutting anything in my presentation. It seems like it's new evidence, so I don't feel it should be, admitted.
Rebuttal has not been addressed yet. That would happen after main presentations.
Okay, we'll proceed, Cam, with your presentation, followed by Rocky's.
The subject property is 835 Sterling Line. The roll number is 100-067-759-555. It's a residential apartment block. It's 6 stories high. It was built in 2019, and it has 133 units with 136 indoor parking stalls and 45 outdoor parking stalls. On page 3 is a picture of the subject property and its location. It's located near the IKEA on Keniston. On page 4 are some interior photos of the subject property from the property manager's website. The units are higher quality than the average new apartment building. On page 6 is our income valuation summary. We use average rents of $1,743 to get a potential income of $2,782,000. We use a 3.2% vacancy to get an effective gross income of $2,693,000. And we use a 36% expense ratio to get a net operating income of $1,699,000. Capped at 4.6%, we have an estimated market value of $36,941,000. On page 7 are our rent comparables. Shows that the rents that we've applied are in line with what's in the market. On page 8 is a summary of the income and expenses for the subject property. In 2020, their income was $2,904,000. Their expenses were $2,085,000, but that included some expenses that we don't normally include, and it also didn't include, it included some management that was maybe a little bit lower than what was in the market. So, so I made some adjustments to the expenses. I removed some appeal fees, which aren't normal, which we don't include for the normal operation of the building, as well as the mortgage expense of $1,398,000. There was a principal reduction that was that we're adding back in because it was it's not a part of the operating income or expenses. And their management was a little bit low at $121,000. So I removed the management of $121,000 and I added the management back in at 5%, which is $145,000. And that gives the operating expenses to be $1,089,000. And the resulting net operating income is $1,815,000. So the $1,850,000 supports the model NOI of $1,699,000. It appears that their actuals are $115,000 higher than what the model is estimated. On the bottom of page 8 is the cost of construction letter that we received, which indicates that the cost of construction to be $34,850,000, and this doesn't include the land value and any builder's profit that would be included in the total value. So we believe that the cost of construction supports the current assessed value of $36,941,000. On page 9 is information on how we derived our cap rates. The majority of our cap rates fall between 4.8 and 5.6%, with some being lower and some being higher. Or some being lower than 4.8 and some being higher than 5.6. On page 10 are some cap rate sales. The range being 3.6% to 5.74%. These cap rate sales substantiate the model cap rates that are being used. On page 11 is an Altus cap rate chart indicating that the cap rate is for 2020 is 4.3%. This is a national chart, but it does seem to be in line with the Winnipeg chart, which is on the following page, on page 12. So the chart on page 12 indicates that the 2017 cap rate is 4.55%. And in the national chart on page 11, the 2017 cap rate is also 4.5. So I believe that the national cap rate trend is similar to the Winnipeg trend. On page 14 and 15 is the income statement provided by the owner. And that income statement information is summarized on my page 8. So when you look at the actual NOI of the property, it supports the model NOI, and it's actually about 115,000 higher. And when you look at the cap rate, the model cap rate is supported by the market. And also, when you look at the cost of construction of about $34,850,000, and if you added land value and builder's profit to that, it supports the assessed value of $36,941,000. So I ask that you maintain the assessed value at $36,941,000.
Thank you very much. Rocky, do you have any questions?
Yes, I do. What's the actual repair and maintenance per unit? Did you work that out?
I did not work it out, no.
Okay, well, I'm just looking at the statements on page 15, and the total maintenance for the building would be, it looks like 202,000, but that includes parking and outside as well, does it not?
It appears so.
Okay, and what would be the expectation for repairs and maintenance on a property like this? Do you have any indication of that?
Usually the indication is that the expenses might range from about 30% to 44%. The expense ratio.
Right, the expense ratio. I'm speaking specifically to maintenance and repair. I'm just wondering if you had done any sort of adjustment on this, as it is a new construction, and typically in the first few years, you won't be running a lot of maintenance or repair. So did you stabilize it for anticipated long-term repairs and maintenance?
No.
Okay. And in your discussion, you mentioned that, sorry, I want to get to the right page here, page 8, that you remove appeal fees as an expense. On what authorities are you relying?
Well, we don't see it as a normal operating expense, so we, for our stabilizations, we remove the appeal fees.
So is this the assessment department's opinion, or do you have any authorities to base this on?
I think it is our view.
Okay. And I've been before several boards on this matter, and when an appeal fee is not specifically listed as such, and it's hidden in accounting and legal, you don't deduct it, do you?
I'm not sure if it's included in other fees.
Okay. And if there was no appeal, is it safe to assume that the taxes would be higher?
If there was no appeal?
Yeah.
I'm not sure.
Well, on that basis, though, perhaps they should just remove the appeal fee and if any possible reduction, which was granted last year, and adjust the taxes up on your philosophy, shouldn't they?
I mean, you can talk about this, and it can be a little bit of a roundabout way, but we look at their taxes as what they were charged.
Well, you're looking at the taxes. You're talking about the statement here, not what they would have been charged. The statement is net after reduction, is that not? Or are you aware of that?
I'm not aware for my stabilization or my summary on page 8. We remove the appeal fee, and because that's what we typically do, and we don't feel it's a normal part of their operations, because there's a lot of properties that don't have that operating expense, and so we don't feel it's a required aspect of operating the building. So with regards to anything that might be related to that, I mean, it's a pretty long discussion potentially, but we're treating it similarly to other properties, so I think we're consistent.
Just be clear that it's your opinion it's similar to other properties. You don't know that for sure, because earlier you answered the question, if somebody hired Mark Newman and he charged them a legal fee, you wouldn't know that was an appeal fee, would you? And you would have that as an expense, wouldn't you?
I'm not sure. We would need the details. If we were indeed able to determine that a professional fee included property tax appeal fees, then we would remove it from our stabilization.
I see. And so you would need the details. In this particular case, did you ask the owner for the details of this?
No.
And they did provide you with a statement, did they not, with a contact name on there?
Isn't it provided in the statement?
It's your evidence. In your evidence,
I believe it is provided in there.
Okay, so they gave you a contact name to call. It's not listed here, but you have one, and you never asked them about it.
About what?
About the how the taxes should be stabilized.
No, we don't consult the owners on that.
I see, and no investigation was done. And then, if hypothetically the reduction in taxes on the previous appeal was 3.2 million, which is
Mr. Neufeld, we're not here to talk about taxes.
Yes, we are. We're talking about expenses. This is an improper process. And
well, you've asked enough questions about this for of Mr. Wong.
I'm sorry. I think this is my right to carry on down this path. I know where I'm going. I know what I'm doing, and this is not appropriate. And I had discussions with the chair, who said you should bring this to debate. I'm bringing it to debate.
Okay, well, move on then.
In 2021, this property received a reduction of $45,000 in their taxes. And for that, there is a fee here of, I think, $19,000. Why didn't you put the reduction back as an expense then if you took the fee off? Why do we just have half the equation in here?
Like I said, I don't feel that the tax appeal fee is a normal operating expense, so I didn't include it. And I treat all the properties in a similar manner.
If it's not an expense, why do they put it in their statement then? as an expense?
It is an expense for them, but I don't feel it's a normal operating expense because there's a lot of properties in the cities that don't have it.
Do you know how the residential tenancies branch treats this as an expense?
No.
In regard to page sorry, I've lost my page numbers here. Oh, here we go. 10. These particular sales, how are these rates calculated?
My colleague had stabilized the net operating income for these properties to the relevant year of the sale, and that's how the cap rates were calculated. On what basis did he do it? What data did he have? Pardon me?
What data did he have?
The income and expenses for these properties.
Did he verify any of these with the participants in the sale?
I'm not sure.
Were they stabilized in the same manner that you're showing us stabilization on page on your page 8?
I believe he stabilized in a more detailed manner.
Sale 2390 McPhillips. Do you know who the purchaser was?
I do not.
Are you customarily allowing the use of REIT transactions as a valid cap rate indicator?
I'm not really too sure, but I am. The property sold for $19,400,000, and we stabilized the income and expense information that we had against that sale price, and that's how we came up with the 4.79%.
Did anyone investigate to determine if this was a market value sale or an investment value sale?
I'm not sure.
Sale number 2 at 700 St. Mary's. Is that the correct age?
I believe it is.
I believe that there was some earlier testimony that that this was new construction. So you believe that it was the original building on this?
I believe so.
Okay, and so you're not aware whether or not that this would have been new construction at a stabilized rate, or at a that had not been stabilized nor absorbed? You have no knowledge of that then?
I don't.
Okay. 203 Bertrand, did you investigate to determine whether or not it had been through a recent renovation?
I did not look at any of the sales on our on the list.
Yeah. Okay. Second, I just wanted to check one more thing I wanted to ask. Oh, yes. Page 11 and onwards, 11 and 12. Sorry, are you saying that page 12 is Winnipeg only?
Yes.
Does not that 100% correspond to page 11 for the multifamily rates, the national rate?
Yes.
Did you read this, the insight, the article?
No.
do you have any knowledge of Altus's investigations into cap rates?
As far as I know, though, this is the what they indicate to be the cap rate for the national and for the Winnipeg market.
Those are my questions. Thank you. Ian, do you have any questions?
I do. Just referring back to, I think it's page 8 on your income workup. The heading cost of construction, the 34,850,459. You had indicated that this came as a result of a letter that had been received. Can you give us some of the details of that, please?
Yeah, like for properties that are newly constructed in the city of Winnipeg, we send out a request for the cost of construction for these new buildings, and the cost of construction letter for the subject property indicated cost of about $34,850,000.
Okay, and from whom is that letter received? Who sends it?
It was either the property manager or the property owner.
And final question, what was the date on that letter? Or do you have that?
It would have been sent at the similar time that it would have been sent. The property was built in 2019, so I think it would have been sent in either 2019 or 2020. But the information is, I guess, would be similar. If it would, regardless of whether it was 2019 or 20. I'm not sure of the date that the letter was received, but this is what was returned for in terms of the cost.
Okay, thank you. I have no further questions.
Thank you. And Carrie?
I have some questions.
And I have no questions. So we'll proceed to your presentation, Rocky.
Sorry, I just have to find it. The income that we used was the previous year, and we never got this latest mailer here with the improved income, and it's obvious that the building was absorbing and the revenues were going up as it went into the market. So I think that it is appropriate that we consider a year later as it's absorbing, and therefore I think that to make things go a bit quicker here today, we're just not going to disagree with the NOI presented by the assessor. His comments about it being lower than the actual, of course, are incorrect, just based on the way it was calculated. But it indicates that there has been revenue growth. So our focus today is on capitalization for this property. And I will go through the rebuttal, and it is all pertinent to the assessor's presentation and the questions I've asked. The rates the way we're looking at these properties begins on page 18, and this is just background material of the Collier's cap rate study. It show explanation of how we do it, and then also what our classes are. And in the multifamily, we have high rise, low rise. I'm gonna guess that this would be classed as a high rise. The main issue is page 19, which is in Collier's drive for the last few years. as more artificial cap rates enter the market, our job is not to embrace those and try to sell them as real. Our job is to help our landlords make money. Very simple. And they don't make money if they don't get a decent return on their investment. And the decent return is derived by the relationship between money markets and cap rates only, not on a sale that hasn't been properly calculated. Now, this evidence was presented originally for a hearing in early September, and there was a schedule conflict, and it has been postponed. So we're at a bit of a disadvantage on that basis, and that we do have a far better updated presentation on cap rates. But the gist of it is that so-called cap rates, reported cap rates, are just not reliable. That one has to go back to the roots of the cap rate, which is, it's a test to determine if you can pay your mortgage. Very simple. It's always about the money. And when somebody comes along and says, we've got a 4% cap, I would immediately say, are you running a charity? Because you're not making money, you're just paying the mortgage. And landlords don't run charities. You need 5% plus returns. You need 4 points on the interest rate and to make money. That's the nature of valuation. The sub 5 rates are just artificial, generally by favorable financing, or they're based on future performance rather than current performance, and that there's some upside down the road. So Colliers over the years has really done a great job of developing some sensible methodologies. We have our cap rate report, which is done now, even though this is page 24 I'm discussing, even though we have Rob's picture down there, the people who report this, who create this and provide the rates, are the investment arm of Colliers in Winnipeg. And that's headed by Brian Talio. He and his people provided these rates. They're based on sales, and they're vetted, and they're calculated out, and they exclude artificial transactions. And when I mean artificial, I mean anything that was done with a motivation, that it wasn't pure and simply the net operating income of the property. If there's other influences, they don't do it. Now, in this report, you can see that they've pegged the multifamily high-rise between 5 and 6%. And that range is a quality issue. The most general description is that wood framing is higher and masonry block or steel framing is lower, typically on new construction. The 5% basement includes closing costs, which we put in our cap rate study. It's because this is what's called the purchaser's cap rate, not the vendor's cap rate. In appraisal and assessment, we use the vendor's cap rate, which doesn't include the closing costs. So it is artificially low. The basement is actually about 5.15% when those costs are taken out. And this, of course, is well known. It's been testified to by Don White at Municipal Board. There's a transcript from time to time we put it in, and it's generally known in the marketplace. The glossary, again, is repeated on page 25 on the multifamily. And the key on these, and you're looking at page 28, 29, is to remind the users that if you don't understand the relationship between money markets and cap rates, don't make the mistake of not understanding it. It's why we exist. And the assessment department in their system, use a return provided, possibly out of date, without verification. And that's really why we're here today, is because they don't bear resemblance to the real world. In the real world, there's no such thing as a sub 5 rate. I think we put in one example in here. This is the most superior sale that's sold, and that's page 3. This capped at 5.49%, and this was marketed by our brokers, and the valuation was done by our brokers, and the highlight in yellow shows it was advertised at this NOI. The time issue on this being 20, I think it's, I can't even read this anymore. I think it was a 2014 or 2015 sale. It is not a major issue because the markets really haven't moved as much. And I do have some rebuttal information on what the assessor spoke of in Altus that speaks to that. So in keeping with this particular sale, we would think that the basement for the best property is 5.15%. And this is one of the better properties. We had it worked out on page 2. Now, this is, I think the major issue with the property, other than, the major issue with the property of any of these factors is the fact that there's no room for an upside at all. So a typical apartment can go to the market, and even with rent controls frozen, you can still get above guideline increases when there's a capital investment. And but it's all about economics, because if you're at $800 and moving to $850 is not a big deal. When you're at $1,700 and you want an increase, it is a big deal. You've capped out the market, because at that point, renters will transition to being buyers. And so there's a ceiling. So I think that the revenue growth potential is limited. Our people put 5.5 on it, but I think a reasonable number is 5.25. And that's based on the best Colliers at 5.15 and a slight adjustment for being at the peak of the market, which is a bad thing, not a good thing. Investors buy a lot on future. Now, using the assessor's number, which I think is all it's fair to rely on today, that comes our request for value is 32,367,295. 32,367,295.
Sorry, what is that? What operating income and cap rate is that based on?
1,699,283 NOI, cap rate 5.25. So that comes to 32,367,295. What are we rounding to? 4 points? Sure. So that rounds out to 32,367,000. Which is fairly similar to what it was in the prior year. And there hasn't been appreciable action. I mean, there's been the last 3 years of the cycle has been punctuated by ups and downs, not growth. And other than my rebuttal, that's my presentation.
Thank you very much. Cam, any questions?
So you're changing your value from 22 million to 32 million?
That's correct.
that would be all my questions.
Thank you. Ian,
No, I don't have any questions. Thank you.
Carrie?
I have no questions.
I have no questions. We will take a 5-minute recess to consider the rebuttal, and we'll get back to you shortly.
Oh, sorry. Now you're considering the rebuttal. You heard the assessor's objections. Don't I have the opportunity to inform you why it belongs?
Well, we should debate whether we're going to allow it first, and then just give us a short time and we'll be back.
Well, I'm sorry, but what would be the opposition to allowing it? Isn't it customary to allow it?
Yes, it is. We haven't seen it.
Oh, okay. Well, perhaps you would let me provide a few words since the assessor has provided his few words.
Certainly, go ahead.
It deals with the Altus study to show you the source of the information, and I had asked the assessor these questions, and I'm providing the answers. The part about the from the textbook on operating expenses, that is not pertinent to this particular property, but it will be to some of the later ones, so I don't intend on dealing with it. And then there's a data verification. I'd asked the assessor several questions about it, so I just wanted the board to review the appropriate methodology. And that was really the extent of it.
Okay, thank you. So 5-minute recess. Thank you very much. We'll reconvene the hearing this morning, and we have discussed the rebuttal from Colliers, and we will accept it into evidence and put the appropriate weight on it. Okay, Rocky, you can proceed with your rebuttal.
Mr. Neufeld, you are muted.
We can't hear you.
No, you're just quicker than me, that's all. Okay, so the issues I was looking at is the first couple of pages is the Altus Insight report that the assessor has quoted from, and it's the report in full. And of a particular note, moving to, I guess, you can read through it, every single page. It does not deal with Winnipeg. It deals with 8 cities that are not Winnipeg. And the page number, I just found this very quickly, the 5th page. The last sentence, it provides investor preferences and valuation parameters for 32 asset classes in Canada's 8 largest markets, which are Ottawa, Montreal, Vancouver, Halifax City, Quebec City, Toronto, and Calgary and Edmonton. There's no Winnipeg in this whatsoever.
How is that rebutting anything that I presented?
Because I asked you a question about it, where it came from, and what it represented. I asked about the difference between what you say is a national number and what you say is a local number. They don't do a local number.
I didn't say it was. I didn't say it included Winnipeg. I said it was a national number, and that's pretty much what you're repeating.
No, you said your page 12 was a Winnipeg number.
Yes.
It's not. They don't do a Winnipeg number.
And if I can just jump in here, Kim, on your page 11,
yeah,
you have quoted national markets. The title to that graph.
Yes.
And I think what Rocky's saying is that they don't do Winnipeg.
Well, I didn't claim that it was Winnipeg. It is a national chart, which it says on the top of my page 11, and he's repeating what I've said.
Page 12 is a national number. It's the same number.
Page 12 was for the Winnipeg Real Estate Forum,
which was the presentation of the national markets insight trends.
Well,
the next thing I wanted to just go over was I'd asked the assessor about how their data was collected, and I wanted to provide the board with the standard that should be applied. And I failed to mark the page number. This is the 13th page. The heading is data verification. This is a publication of the Appraisal Institute of Canada.
Just let us get there.
Yeah, I'm stalling here. Okay.
Everybody got it? It's page 13 of the PDF.
Yeah.
Okay.
And I've marked some passages, the opening passage on the 13th page, and then the second page, there was a area about realtors are to be considered a very strong source of verification, and helpful in eliminating potential errors in the appraisal report. Essentially, people who are involved with the transaction are what are suggested as verification. And then the last section to highlight is on the next page, and it's a long passage. The key item to take away from this is that the degree of reliance that you're placing on data requires that sets the standard for the level of verification. Now, what that means, if you're coming into a hearing like this one today, and where there are financial penalties or rewards or whatever that are associated with your interpretation of the data, your verification requirements are higher. And this is the Appraisal Institute, but this is the standard that the IAAO and the Manitoba Association of Assessors have to follow too. It's enshrined in their guidance. So when an assessor comes to you and says, well, we've read the income and expense report, that's not enough. You have to call the person who did it, talk to the people involved in the sale to understand how this works. This is not a data processing service where bulk data is brought in and shot out and presented. We're supposed to do our due diligence. And everything we present to you, this board, comes through a dual level. We have the reporting of the sale and we have the verification with the participants. Because if I don't do that, then I lose my license. And that's just something that people just don't get. We're not here to advocate and tell you it should be this because we believe it's that way. I am not the creator of these cap rates. I'm the purveyor of the cap rates. And that's what we should be doing. We're not making them up for a purpose. And that's really the real problem with this system, because half the cap rates the city has brought forward will not meet the standards. And that's my closing argument as well. Thank you.
Thank you. Cam, do you have any questions?
I guess just with regarding the, Mr. Neufeld was talking about verifying data, and I was just wondering how well did you verify the data in your submission with regards to the income and expenses? How well did you verify that?
Oh, it's completely verified. The issue that I brought forward is that it was a year old, and therefore was less reliable. That's not verification. That's just a wrong. Dated information. It's true. Okay,
so you didn't include the most relevant information?
No, I believe I stated that already, that we didn't have it.
Okay, and does that meet standards in your opinion?
Standard. I'm just looking here. It's older, is what it means. It meets the standard, but it's older.
Okay, and having a valuation go from $22 million to $32 million, does that meet appraisal standards?
Absolutely, because one of the things that's important here is to be reasonable and to make good judgments. And when you see something that's wrong, you don't sit on it and hold your line and try to bluff your way through it. You correct it. That's what responsible, reasonable appraisers are supposed to do. I caught this. I didn't prepare this information. I caught this and I said, we're not going to submit this. And I'm correcting it.
Okay, that would be all my questions.
Okay, thank you. Ian, any questions?
Not on the rebuttal, thank you.
Carrie.
I have no questions.
And I have no questions. So that concludes the first property on the docket. The next, then we'll have to get there. The next property is 825 Sterling Line Parkway. Any preliminary issues, either party?
No.
No.
Okay, Kim, you can proceed with your presentation. And if you had covered some of the documents from the first property, you can carry those forward.
Yes.
Okay, proceed.
Okay, the subject property is 825 Sterling Line Parkway. The roll number is 100-067-75960. It's a residential apartment block that's 4 stories high. It was built in 2018 and it has 68 suites with 50 indoor parking stalls and 60 outdoor parking stalls. On page 3, it's the picture of the subject property with its location. On page 4 are some interior photos of the property from the property manager's website. On page 5 is our income valuation summary. We use average rents of $1,647 to get a potential income of $1,344,000. We used a 3% vacancy to get an effective gross income of $1,301,000. And we used a 38% expense ratio to get a net operating income of $803,000. Capped at 4.35%, we have an estimated market value of $18,483,000.
And the recommendation?
Yes, on page 7, as a summary of the income and expenses. The operating income was about $1,234,000, which is lower than what the model is estimated at $1,344,000. And once again, adjusting their expenses from $932,000 to $536,000. Their net operating income is $698,000, which is lower than what the model has estimated at $803,000. So I'd like to recommend a revised value of $16,053,000, which is on the bottom of. Yep.
And Rocky, how do you feel about the recommendation?
Well, I appreciate it, and it's a step in the right direction. I think we still have 2 issues, so we've narrowed things down quite a bit.
Do you have any questions of Kim?
I just have a few, much fewer, considering your remark about carrying forward. Just to clarify that again, there is on page 7 on your workup, which you did end up relying on, that you're still sticking to the line that appeal fees are not an expense then, is that correct?
Yes.
And in the last appeal, that was a newer building, and this one is a few years older, I guess 3 years older. Why would, and it's next door, why would the cap rate be lower for an older building?
I'm not sure what the difference in cap rate is, but the 4.35 cap rate does seem to be is in line with what is in the market. So I feel it is appropriate.
Was this cap rate done by the market or done by your model?
The model.
Okay, now how does the model allow an older building to have a lower cap rate than a newer building next door?
I'm not sure about about why the cap rates might differ from this one or the previous one, but the cap rates do seem are substantiated. So that's the way that I'm looking at it.
Those are my questions.
Thank you. Ian, any questions?
No, I don't. Thank you.
Carrie. And I have no questions. So Rocky, you can proceed.
Yes, The main issue is I appreciate what the assessor has done with the workup, and by and large, it's appropriate. The error is the exclusion of appeal fees, and I will touch on that in the rebuttal information. And other than that, no objections to the NOI. The issue, the second issue being the cap rate. You've heard my one concern with it. The second is what I've already stated already. Sub fives don't exist, not in the real world. There's something wrong when someone does that. It's either got favorable financing or it's being done for future benefits. I want to adjust the cap rate on this one down slightly, just based on the comments I've made earlier about really this is the best product you're going to see in the market. But 5.25 is, in our terms, the best that one should expect, and that number is at 5.25% is adjusted upwards to 12,962,210. So 12,962,210 rounded 12,962,000. And with all due apologies to the board, this was a very early preparation for us, and we're slow starters. That's not a crime. So I think it's always fair to relook your work, your initial work, and do your best to see if there's anything that you would like to change, and that's what I'm doing.
So just to clarify something, were you using the assessor's NOI?
No, I'm using my own NOI, which differs by $18,000. And the main reason being his appeal fees. Now you can see what he's done. If you took his adjustment for management, which was increasing it, and taking the appeal fees, which is decreasing it, that's exactly the amount of difference that we're talking about. We're using actuals management, which is lower than 5%, not cherry picking. And we're using actual appeal fees, which are an actual expense. So essentially, you strike out his three lines, and we're both going to be at 680,000 or thereabouts.
Okay, thank you for the clarification. Cam, any questions?
No questions.
Gary,
No question, thank you.
sorry. Ian,
I don't have any questions, thanks.
and I don't have any questions. So that concludes 825 Sterling Line Parkway.
Well, except for the little bit of rebuttal I wanted to talk about.
Was that the rebuttal we just heard before?
No, this is the other part, the brand new stuff.
Okay, we're just going to check on it.
What it is an excerpt from the Appraisal Institute on what constitutes an expense and what doesn't.
That included in the rebuttal document you already submitted?
That's correct.
Okay, thank you.
Oh, okay. So let's get back to it. And let us know what page you're on.
Okay. It's the big blue picture on, I guess, the 6th page. So this is the textbook, the main textbook of the Appraisal Institute. And if you are getting your appraisal designation, either AIC or you're getting a DULE, which DULE, which many assessors carry, this will be the textbook that you get taught through the university UBC. And this is the one everybody follows. Now, it is a textbook, but it's great for explanatory notes. The next 2 pages are from chapter 21, exclusions from reconstructed operating statements. This is what you exclude: depreciation, depletion allowance, income tax, corporate costs, additions to capital, and loan payments, not reasonable expenses. Any expense that impacts the bottom line is an expense. And the exclusions are ones that are extraneous to it. So if you would hire an appraiser to value the property, not an expense, because that's to get your loan. You hire an appraiser to deal with a problem to improve your earning capability. That is an allowable expense. Same with a lawyer, same with an accountant. The textbook, then I've got excerpts and I put this in reverse order because I'm a bit dyslexic, starting page 2116, which is be the 9th page, and there's no heading, but the first paragraph is effective gross income. This is just the backup narrative. Just the explanation, and there's a section here about fixed expenses and taxes. The box that's circled on the 11th page explains why we use the actual management fees, because the expenses that would vary with the level of occupancy or the extent of services provided, management. So they do change from property to property. There is no such thing as a standardized rate. And if there were, if you embrace that principle, then why are we looking at different incomes? Why are we looking at different caps and arguing about them? It's the same concept. Every property has some site-specific issues, and not all apartments are going to be the same. You won't take a luxury high-rise and compare it to a 100-year-old converted loft, because the costs are different, and one has to take that in and consider it. That was it. Wait, there was a, no, that's fine, thank you.
And this whole document will then carry forward for the rest of the property.
That's correct.
Cam, do you have any questions?
No.
Oh, sorry, I apologize. This is not so much as information for the hearing, but I have filed this with 311 as a bias complaint, and I just want to bring that up so that it's on the record. And that's the last part of it, that the way it's been applied. And I don't expect that to weigh in your decision. That's just transparency.
Okay, thank you very much. Ian?
No questions, thank you.
Eric? And I have no questions. So that concludes 825 Sterling Line Parkway. The next property on the docket is 815 Sterling Line Parkway. And just let us get there. Okay, Cam, you can proceed. Any preliminary issues before we start? Either party?
No.
Thank you.
Okay, the subject property is 815 Sterling Line Parkway. The roll number is 100-067-75965. It's a residential apartment that's 4 stories high. It was built in 2018 and has 60 suites with 42 indoor parking stalls and 48 outdoor parking stalls. On page 3 is a picture of the subject property with its location. On page 5 is our income valuation summary. On page 7 is a review of the income and expenses submitted by the owner. you look at the bottom, their income for 2020 is $1,333,000. That's a little bit higher than what the model is estimated. But when you look at their, when you consider their 2019 and 2020 expenses, their net operating income is $608,000, which is higher than what the model is estimated at $650,000. So I'd like to recommend a revised value of $14,151,000.
Okay, Rocky, how do you feel about the rec?
Well, I think it's the NOI was well done. It matches the actual performance. So perhaps if we can just move on to discuss the cap rate.
Certainly, go ahead.
Okay. On page 8 and 9 is information on how we derived our cap rates and some cap rate sales. On page 10 and 11 is some Altus cap rate information. And the remainder of my brief is the income statement provided by the owner. So the revised NOI is supported by their actual NOI, and the model cap rate is supported by the market. So I ask that you accept the revised value of $14,151,000.
Okay, thank you, Rocky. Any questions?
Yes. So actually, this is the same question as earlier. We have a building that you got an age on it of it's older than the first one at 4.6, the same age as the last one, which was at 4.35, and this one's at 4.3. Why is there a difference?
I'm not sure what the difference would be in terms of the algorithm, but as with the previous property, the 4.3 is supported by the market, and so I feel it's reasonable.
Okay, now first of all, I do have to correct myself. I erred discussing your page 9, 700 St. Mary's. I was thinking of a different building, so that's disregard what I said about it being new construction. But I just looked it up, and there were building permits right before the sale. So could that have been a renovation project where you haven't caught up with the income yet?
I'm not sure.
And which one of these numbers on page 9 best represents the subject?
It would be the McPhillips property.
Okay, and that number is higher than every one we've seen so far then, correct?
Yes.
Thank you. Those are my questions.
Thank you. Ian, any questions?
Just a question with respect to 815 Sterling Line and 825 Sterling Line. These buildings are virtually identical with the exception of 8 additional one-bedroom suites. Would that be correct?
I think so.
And the pictures the pictures that you have included at page 4 of your brief are from the property manager site or the...
Yes.
Okay. Okay, thank you.
Thank you. Carrie, any questions?
Just one. So, Mr. Wong, further to the questions of my colleague, would this not be considered a sister property to 825 Sterling Line Parkway?
Yeah, I believe they're all operated together, and I believe they have a common gym area, and they have common areas that I believe are utilized by the 3 buildings.
Okay. And so the difference in cap rate is just due to the modeling?
Yes.
Okay. Thank you. That's all my questions.
Thank you, and I have no questions.
I'm sorry, I missed the question, and I think I misunderstood something here. Page 7. You're stating that in 2020, 564,302 was the actual NOI. You're not using that then, though, are you?
No. Like for the income, I used their 2020, and I average your expenses for 2019 and 2020.
Yeah, but when you averaged both NOIs for both years, one was 507, the other was 564. But you're applying 608. Then my apologies. I should have brought this up earlier, but I wasn't following along.
Yeah.
Are you're the 608 then is what you're using?
Yes.
Okay, and it doesn't say in the document where that came from then, does it?
It if you in that chart, it shows you.
Oh, I see what I see what you did. Okay, I understand. So you average the expenses,
yeah,
and use the 2020 income.
Yes.
Okay. Hey, sorry about that. Yeah, I know I was out of order there, but I'll just carry on with my presentation now. I just wanted to clarify that.
Yeah, go ahead.
Okay, so what we did is, because we did have 3 years of operating income, it's presented in summary fashion on page 1. And it doesn't differ greatly from the assessor's calculation of the actual NOI, but there's two things that show up in there. One is that they had good 2018 revenue, but it dropped for 2019. So this is the zigzag effect, or the hacksaw effect, whatever you want to call it, sawtooth effect. With these new properties, they come out and they offer suites for rent, and there's a free year and a month per year involved. People take a 1-year lease, and then next year move to the next property down the street that may offer the same thing. And this is a stabilization issue over the years, where it takes often 5 to 10 years for them to hit proper stabilization. And when we looked at it, we knew that this is what had happened. That's issue number 1. Issue number 2 is the expenses. And you'll note that over 3 years, they gradually rise. That's because they're no longer new, and expenses have begun to come up. And the biggest expense is always suite turnover. So the stabilization has to take that into account. So what we're looking at here is, I accept the premise that the 1,133,000 is the income. I do not accept the premise that the expenses should be averaged, because this is just a growing issue. One should then take and compare it to budgets, or to expectations, or to reserve allowances. That's the proper way of doing it, and I've already provided that in rebuttal. It's really boring reading material, but that is the proper methodology. So we are using 564 440, which would be the last year, which in this case was the year that they became stabilized with their absorption. Again, so that's just the minor difference, is that the expense issue is not a question of averaging. If this building was 20 years old, I would accept the assessor's premise. It's 3 years old, so it's caused by a different reason, which is something that will now continue at the higher expense rate. And like before, I'd like to adjust the cap rate lower as well, to the same number. And that's brings the value upwards to 10 million. Sorry, the number would be 5.25% on NOI 564,440. The value is 10,751,238. And brief summation on what we've heard when it's appropriate.
So just to clarify, your revised value is 10,751,000
That is correct.
at a cap rate of 5.25%.
That is correct.
Okay, if you want to go ahead with the summation.
Unless there were questions or the assessor had something.
Kim, did you have questions?
I've done more of these hearings than you. I remember the routine.
Yeah.
Kim, any questions?
I guess in my experience, expense ratios for newer buildings might range from about 30 to 45%. So you feel a 50% expense ratio for, I guess, a new building is appropriate?
It will be at this level for the next few years. One of the reasons it's so impacted by it is, and I'm just going to double check before I open my big mouth, yes, they're heavily impacted by vacancy rates as they absorb. So absorption is a 5 to 10 year program.
That's all my questions.
Thank you. Ian, any questions?
No, I don't have any questions. Thank you.
Carrie?
I have no questions.
And I have no questions. Certainly. We're going to take a 5-minute recess.
Oh, do you want me to give my 30 seconds before the recess?
Okay,
I'd like to go too. The thing, so this is an issue we haven't discussed, but there is, the numbers were agreed on the way the numbers should be calculated. It's just the application, and the issue is how long do you consider for absorption for a new product? And remember that assessments are not forward looking. They're what has happened in the past. And so if in 5 years time things are better, great, you get to reassess it. That's the way the system works. The concept of the cap rate, the assessor, I asked him who was his best, 4.79. It was an investment sale, as it was testified to earlier. They had different goals, far more aggressive, and he's got it at 4.3. So I think we're reasonable. Thank you. Sorry.
Thank you.
That.
We will reconvene the hearing this morning, and the next property on the docket is 795 Sterling Line Parkway. Any preliminary issues with this one?
Nope.
Kim, I think you're muted.
No preliminary issues.
Okay, thank you. You can proceed with your presentation.
Okay, the subject property is 795 Sterling Line Parkway. The roll number is 100677. Sorry, the roll number is 10006775900. It's a residential apartment block that's 4 stories high. It was built in 2016 and it has 68 units with 52 indoor parking stalls and 62 outdoor parking stalls. On page 3 is a picture of the subject property with its location. On page 5 is our income valuation summary. And on page 7 is a summary of the income and expenses of the owner. I've calculated their NOI to be approximately $622,000, which is much lower than what the model is estimated at $772,000. So I'd like to recommend a revised value of $14,316,000.
And Rocky, how do you feel about that revised value?
I think we'll just talk about the cap rate, if that's okay with the board.
Certainly.
Okay.
On page 8 and 9 is information on how we derived our cap rates and some cap rate sales. And on page 10 and 11 is some Altus cap rate information. So the revised NOI is supported by their actual NOI, and the model cap rate is supported by the market. So I ask that you accept the revised value of $14,316,000.
Thank you. Any questions, Rocky?
Yes. Well, there's the same question as before. Now, this is the oldest of the Sterling Line properties, and it has one of the lowest cap rates. So again, you don't know how the model does that?
No.
On page...
when you say oldest, I'm not sure if you can distinguish between a 2016 and a 2018 building.
Well, if you're a 17-year-old getting to the bar, that's a big deal. On page, it's why should it? The point here isn't why is it different? Why it's lower? It's why should it even be different? Isn't it? I guess is my question. Sorry, I don't. You didn't provide an aerial photograph in this one, did you?
No.
You'll obviously see later that this property backs onto a railway. Does your model do anything with the railway adjacent properties?
I'm not sure.
Okay, but there's in your model you've got, or in the descriptions on the city's webpage, it'll say heavy traffic or issues, location issues. Is the railway part of the valuation process?
I'm not sure if it is or if it isn't, but we generally look at how accurately the model projects the operating income of the property. So, but I'm not sure if it considers that or not.
Thank you. That was my question.
Thank you. Ian, any questions?
I have a question about possible effects on cap rate, and I noticed that this property has a larger land to plan ratio. Does that have, I think it's 4.7, 4.787 land plan area ratio. Does an increased ratio affect the cap rate move it down or move it up, or can you comment on that?
I don't know, but I don't believe it does.
Okay. Thank you.
Thank you. Carrie.
No questions. Thank you.
And I have no questions. So Rocky, you can proceed with your presentation.
Thank you. I know I can't answer questions for the assessor, but from an appraisal perspective, land ratio on multifamily is generally becomes a non-issue because it's usually based on how many units you develop, and once it's improved, it's improved. There's no pickup down the road on the land, whereas in a retail you may have more pad site space. But we haven't considered that, and I just found it an interesting question. As I mentioned, we're not going to make a big deal about the difference in income. It's clear why we've done it. We have a difference of $10,000, and the difference between the assessor's change on the management fees and deletion of the appeal fees is essentially the difference. And so you've heard it already. As with the other properties, this is a whole, these properties are actually all related, and it's a good part of town. It deserves to be at the lower end of the range, but the real range. And the only market evidence you've seen anywhere about people providing cap rate information from the real market is Colliers, because we're the only company that has been discussed today to actually sell them. And we don't. These aren't desk jobs. They sell these properties and they track them and they relate to real value in the world and what people are willing to pay for a property on the appropriate terms. So as with the other ones, the lower end of the Colliers range, as I mentioned, was 5% for a perfect site, but that's with closing costs in. So adjusted for that and the lack of growth to 5.25%. So my number becomes, and I'm working off my own NOI of 6,112,480. So a slight upward adjustment to 11,666,286. 11,666,286 rounded to 11,666,000. That's my presentation.
So what cap rate are you using?
So I'm sorry, 5.25%.
Okay, thank you. Cam, any questions?
I guess on your page 1, you're indicating that the 2020 assessed value is $13,000,001, and now you're suggesting a value at least $1.5 million lower than that.
Yeah, that's a hangover from the last appeal, and that wasn't the final number. It was there was a change at the board, and it was reduced. I don't have the number in front of me. I can have it in about 10 seconds if I can find it.
That's okay. We don't compare assessments.
Yeah, okay.
That's all my questions.
Thank you. Ian?
No, I have nothing. Thank you.
Carrie?
No question.
And I have no questions. Thank you very much. The next property on the docket is 800 Dover Court Drive. Any issues on this one?
None.
No.
Okay, Cam, you can proceed.
Okay, the subject property is 800 Dover Court. The roll number is 030-929-78555. It's a residential apartment block that's 5 stories high. It was built in 2013 and has 155 suites with 104 indoor parking stalls and 129 outdoor parking stalls. On page 3 is a picture of the subject property with its location. On page 4 are some interior pictures of the subject property from the property manager's website. On page 5 is our income valuation summary. We use average rents of $1,584 to get a potential income of $2,947,000. We use a 4.2% vacancy rate to get an effective gross income of $2,823,000. We use a 38% expense ratio to get a net operating income of $1,749,000. Capped at 4.75% to have an estimated market value of $36,839,000. On page 6 are some rent comparables showing that the rents we've used are in line with what's in the market. On page 7 is a summary of the income and expenses for the subject property. You can see in 2020, their income went down from $2,898,000 to $2,778,000. When you look at the bottom chart, trying to establish their net operating income, I used the 2020 income of $2,778,000 against the average expenses of 2019 and 2020 at $980,000, estimating their operating income to be $1,798,000, and that supports the model operating income of $1,749,000. On page 8 and 9 is information on how we derived our cap rates and some cap rate sales. On page 10 and 11 is some Altus cap rate information. The remaining pages are the income statements provided by the owner. So when you look at the actual net operating income of the subject property, it supports the model NOI, and then the model cap rate is supported by the market. So I ask that you maintain the assessed value at $36,839,000.
Thank you. And Rocky, do you have any questions?
Yes, I do. This property is so far the oldest we've discussed today, dating back to 2013, and this one actually follows a bit of a better level of continuity in that it's also has the highest cap rate that we've seen today. And so going back to my same question with the model, does it work?
What's the question?
Does the model work if it's not being consistent with the ages of properties in the same neighborhood?
Well, I believe the model does work because, like, when you look at the final values and you measure the estimated values that the model is generating, and you compare them against actual sales, they do measure up very well, and so I do feel it works.
In regard to your adjustments to calculate actual on page 7, why didn't you make a deduction for the property tax appeal?
Was it in there?
I'm just asking you. Is that your answer?
Oh, I'm asking you. Where is it?
I don't know. I get to ask questions. Why didn't you make an adjustment?
Because it wasn't listed in their income statement.
Okay. Now, it wasn't listed specifically, but did you look at some of the other expenses? Say, for example, page I have to find this one right here. I have found it and I lost it. Okay, sorry, page 14. for example, professional fees. You allowed that expense.
Yes.
Okay. And do you know what it was for?
No, I don't know the details. No,
Could it have been for an appeal fee?
I'm not sure.
Okay, so thank you. That's oh yeah, no, the other question I had for you, did you do any investigation about the drop in income? Is this something that a market issue?
No, I didn't investigate it.
But it does appear from looking at the statements that there's a difference in income based on vacancy, correct?
Yes.
And the statements that you've provided, okay, and they utilize a February year end then. So the one ending right before the reference here had the higher vacancy then, correct?
Yes.
Okay, those are my questions.
Thank you. Ian, any questions?
No, I don't. Thank you. No questions.
And Carrie?
Yes, Mr. Wong, just further to what Mr. Newfeld brought up in regards to vacancies, on your page 7 of your brief. So with the drop in income, you didn't think to adjust the vacancy rate because you got 4%?
When I was looking, I mean, the income that I use is inclusive of the vacancy.
Okay. Do you know if the property is offering any incentives?
Yes, they are.
Do you know what the incentives are?
If you look on my page 13, it looks like they're applying discounts of 31,942.
Okay, thank you.
Thank you, and I have no questions. So Rocky, you can proceed with the presentation.
Thank you. We're using the actual last year's income of which shows a decrease from vacancies and discounts offered, and you can see that is about $100,000 lower than it had been the previous year, and that's just market ups and downs. The expenses in the case of this particular property, I mentioned earlier about the startup expenses. They have moved past that stage. I do know that they have a very rigorous suite changeover program in place, where typically their budget for turning over a suite is $2,500 plus. It's a very extensive redo of it, and very, very familiar with this property from the day it was built. The lower income, it was something I'm just, I guess, looking at here now, and I think that it's a periodic thing rather than a permanent thing, but it does show that the properties in Winnipeg, all of these buildings are showing revenue decreases in the COVID years, which they were building more apartments, and that's likely why, because the market got saturated and there's more competition in the market. So this is if you look at the forecast of going forward about how many more apartments are underway now, we're going to see a change from that 0% or 1% vacancy to lower levels and then more discounts. And this is again if you're investing in one, you're not going to be an optimist. You're going to be a pessimist as to what the future holds if you're actually contemplating that. I mean, a pre reference date land that is now being considered multifamily is well over 100 acres in the south end of town. So we're going to see more projects, more competition, and decreasing vacancy rates. Having said all that, this is, I think, one of the best properties in the city, and it does have room for revenue growth because it's had a stall and it's had a history. So I actually would like to adjust this to the lowest possible cap rate that makes sense, which is 5.15%. On the low level of income. And the alternate way of looking at it is averaging it out and using a higher number, but they'll come up to the same value, and that changes my number to 34,071,534. 34,071,534 at 5.15%. Rounded to 34,071,000. And I'm going to keep saying this. It's my mantra. That's the lowest sane cap rate that we should ever consider on real properties where people actually have an intent to make money renting them. Thank you.
Okay, thank you. Kim, any questions?
No questions.
Ian.
Just looking at page 1, your aerial view of this, the pin is on the left-hand side, sorry, the right-hand side of the picture. This is an L shape. There's 2 buildings on this lot. They're both assessed separately? Or?
No, it's one property. They've got a connecting way between them, and there's underground parking. So it's one complex.
Okay, thank you. That was my only question.
Carrie. And I have no questions, so that concludes 800 Dover Court. The next one on the docket is 424 Osborne. Any preliminary issues?
None.
No.
Okay, Cam, you can proceed.
The subject property is 424 Osborne. The roll number is 120509. Sorry. The roll number is 12015090000. It's a residential apartment block that's 2 stories high. It was built in 1962 and it has 21 units with 13 outdoor parking stalls. On page 2 is the sale history of the subject property. It sold in 2017 for $1.8 million. It also experienced a rehabilitation and renovation cost of $595,000. On page 3 is a picture of the subject property with its location. On page 4 are some interior photos of the subject property. On page 5 is our income valuation summary. We use average rents of $1,062. You get a potential income of $267,000. We use a 3.2% vacancy to get an effective gross income of $259,000. And we use a 42% expense ratio to get a net operating income of $149,000. Capped at 5.75%, we have an estimated market value of $2,599,000. On page 6 are some rent comparables showing that the rents we've used are in line with what's in the market. On page 7 is a summary of the income and expenses submitted by the owner. Their income was $265,000. Their expenses were $165,000, but that included some mortgage expense. So I made some adjustment for that. And their operating expenses end up being $104,000, giving a net operating income of $161,000. The $161,000 supports the model NOI of $149,000. On page 8 and 9 is information on how we derived our cap rates and some cap rate sales. On page 10 and 11, some Altus cap rate information. Page 13 is the income statement submitted by the owner. And if you go to the bottom of page 15, and the current owner purchased the property for $1.8 million in 2017, and then proceeded to rehabilitate the property with approximately $600,000 worth of work to it. The total of the sale price plus the renovation cost is about almost $2.4 million in 2017. So this supports the current assessed value of $2,599,000. So the actual net operating income supports the model, and the sale price plus the renovation costs also support the assessed value. So I ask that you maintain the assessed value at $2,599,000.
Thank you. Rocky, any questions?
Yes. So your testimony was that it sold for 1.8 million and the permit was 595,000. Is that what you said?
Yes.
So that totals 2,395,000.
Yes.
Correct? Okay. And I take it that page 5 is all by the model?
Yes.
And in this case, an older apartment, what's the effective age on this being 1962? That then is an indication of 5.75%?
Yes.
Now, why didn't you, on your page 7, in your calculation, make deductions for the property tax appeal? It's right there on page 14.
I missed it.
And with, I guess we have 21 units in this building. Was there thought given to making an adjustment for first year after renovation and lower repairs and maintenance?
It was renovated in 2017, no?
So I didn't hear you say that.
It was renovated in 2017, no?
Was that your testimony? I didn't hear the date of the permit. I'm sorry.
Okay. Well, you were talking about making an adjustment of the year of the renovation, but I thought, as far as I know, it was, I think maybe 2017 or 18.
Okay. Sorry, if you said that, then that's fine. I didn't catch that. Okay. Those are my questions. Thank you.
Thank you. Ian, any questions?
No, I don't have any questions. Thank you.
Carrie?
No questions.
And I have no questions. So Rocky, you can proceed with your presentation.
Thank you. Now, the assessor mentioned something about the renovation, and of course, these do not happen overnight. The permit is in fact dated 2017, but the completion wasn't for some time thereafter. in our opinion, this is still in the stabilization era. And one way of seeing that is when you look at the statements and you see the application of continuing residential discounts. So these are gradually coming off and the property is stabilizing. And when that happens, the expenses.
I'm sorry, what statements are you referring to? You're talking about income statements?
That's correct. As this happens, the repair and maintenance will be going up as well. So on that basis, we didn't think we'd have a very fair analysis of it from the operating statements on this. We did end up using the assessor's numbers because it's very, very similar. And with adjustments, it would be virtually identical. And I'm just trying to give you the background of what we do to determine if this is reasonable or not. Our cap rate was 6.25%, and that, of course, is starting with our base rate of 5%. I'm speaking to page 2. The closing cost adjustment, the lack of parking. This is not located in the downtown area. So we have 13 stalls, and under code, you need 1.4 stalls per unit. So that would require 29 stalls on a new build. As an old site, they do get grandfathered in, but it's so the impact is it's legal, but you're limiting your potential rent by limiting the number of cars. The change we made in the cap rate is 0.1%. These are all very, very small adjustments. And as opposed to the other properties heard today, 21 units is not an economically preferable number of units. The expenses, fixed expenses, and that was in the rebuttal material, the discussion between fixed expenses and variable expenses. Fixed expenses tend to be very, very similar for properties. And, you know, if you have 155 units to split them over, you have a better economic model than only 21. And the same with vacancy. If one unit goes vacant in a large complex, that's 1%. If it goes empty in this complex, it's 5%. That's the problem with the smaller size buildings. The design issue is that there are still bachelor units in here, 3 bachelors, and mostly 15 one-bedrooms and then 3 two-bedrooms. So the mix isn't great. Bachelors are not particularly great in the investment market. The best mix is a fairly even ratio between 1 and 2 bedrooms. And what this then allows is multiple tenants, so apartment sharing, and which then it opens you up to greater potential for rent. And the age, it's 1962, so you can renovate a lot of things, but you can't renovate the frame, the foundation. It is what it is. So that's what we came up at 6.25%, which, and it's not a coincidence. It equals the amount that they paid for it and the amount they invested in it, and the rest is just rounding. 2,391,000. 2,395,000 is also an acceptable number. And that's my presentation.
Thank you. Kim, any questions?
Yeah, I was just wondering, you were talking about the income statements. I was just wondering what you were referring to. I wasn't able to find it.
Oh, okay.
Like what income statements are you basing it on?
Well, I have income statements, and they're in the you said you couldn't find any. I'm looking at your page 13 and 14.
Oh, sorry. I thought I was looking for it in your brief.
Oh, no, we had these as well, and when we looked at them, we realized that there's no challenge to the income. The minor variances are due to other issues. So no, we not looking for fights for nothing.
Oh, so you're basing it off of our information.
Well, your number's gonna come to the same as ours once we adjust for repairs and maintenance.
Okay, no, I just wanted to know where you're getting your information from.
So, you know, there's no issue to be made there.
That's all my questions.
Thank you. Ian, any questions?
No, I don't have any questions. Thank you.
Carrie?
I don't have any.
I just have one question. Do you know the extent of the renovations?
Yeah, I was just reading it here. Replace windows, install new kitchens, new bathroom fixtures, paint, refinish hardwoods, replace front door hardware, lights, plugs, switches, drywall and fire stopping is required. And then there's some water line repairs, and then the electrical permit is for new panels for each unit and some additional plugs. So they offloaded their electrical with separate metering.
Okay, thank you very much. That was my only question. That concludes this property. And the last property on the docket today is 2815 Pembina Highway. Any preliminary issues?
No.
No.
Okay, Kim, you can proceed.
Okay, the subject property is 2815 Pembina Highway. The roll number is 030-929-85355. It's a residential apartment block that's 7 stories high. It was built in 2015, and it has 89 suites with 37 indoor parking stalls and 95 outdoor parking stalls. On page 3 is a picture of the subject property with its location. It's down Pembina Highway, somewhat close to the perimeter. On page 4 are some interior photos of the subject property from the property manager's website. On page 5 is our income valuation summary. We use average rents of $1,472 to get a potential income of $1,572,000. We used the 4.2% vacancy to get an effective gross income of $1,506,000. And we used the 41% expense ratio to get a net operating income of $877,000. Capped at 4.5%, we have an estimated market value of $19,496,000. On page 6 are some rent comparables, showing that the rents we've used are in line with what's in the market. On page 7 is a summary of the income and expenses submitted by the owner. In 2020, their income was $1,541,000. Their expenses were $620,000, and their net operating income was $920,000. The $920,000 of actual income supports the model net operating income of $877,000. On page 8 and 9 is information on how we derived our cap rates and some cap rate sales. On page 10 and 11 is some Altus cap rate information. The remainder of the brief is the income statement supplied by the owner. So when you look at their actual net operating income, it supports the model. It's about $43,000 higher than what the model is estimated. And the model cap rate is supported by the market. So I ask that you maintain the assessed value at $19,496,000.
Thank you. Rocky, any questions?
Yeah. Just sorry, I'm just playing catch up here. Your calculation of on page 7, you came up with 920,000. Now I see the 1,541,000. I'm just wondering from your expenses, what you did on which expenses were included, and I'm going to page, I guess 13 and 14.
I included the operating expenses and the admin and general expenses.
Okay, so I see the operating, and that's 496,000, and admin was 124,000.
Yes.
You put all of those in?
Yes.
Okay, and then of course disregarded the amortization and the interest.
Yes.
Okay. Now, did you investigate the parking situation?
No.
So, do you know anything about the parking situation to begin with?
No.
Okay. Thanks. And
Speak to it. You can do it in your presentation.
I don't know. I'm just asking you. That's all. And in this particular one, 2015 construction and at 4.5%, which again is kind of out of sync with the Dovercourt properties included in there being relatively out of sync. Same issue. You don't know what the model did?
No.
Okay. And the aerial, did you provide an aerial view?
No.
Okay. And again, same question as before. Does you have any idea if the model considers the adjacent railway to be an issue?
And the answer is the same.
Okay. Just getting it on the record. Okay. Thank you. Those are my questions.
Thank you. Ian, any questions?
No, I don't have any questions.
And Carrie?
No questions.
And I have no questions. So Rocky, you can proceed with your presentation.
Thanks. Again, this is a situation where we felt we had no choice but to use the assessor's workup. This is if you look at page 1, there's an aerial, and it shows the subject property with the red dot. Now, the two properties immediately east of it are owned by the same people. So what we have is a situation where rental fees that are put onto this property are actually for rent on some of the other sites, the off-hours rents. So we didn't have a breakdown, and rather than present you information, this is one of these issues with the legislation. I think the Act clause is 56.3.2, if I'm not mistaken, where if we provide evidence that differs from what's already been presented, it can't be listened to, and that's what we would be doing. I think in the long run, these should have been treated as one economic unit, but that gives rise to other issues. So there is a lot of crossover on there, and the parking needs of the subject, this particular subject property, are not being met by its just its own parking alone. So we did use the assessor's workup just for that reason. There was no advantage in my mind on this. As far as the cap rate is concerned, I think we're not going to make a change here on this because this isn't the best property. This is the focus on this property was different at the time it was built. It was a remnant piece of property in a regular shape, and the rail line behind it, you see on page 1, is the CNR, Letellier main line. So one of the busier rail lines in Winnipeg. It does have separation from the building to the line of 200 feet, but that doesn't provide for a pleasant view, and it does still have vibrations. So there are several apartments with on Pembina Highway that are situated adjacent to the L'Atelier line, and that's because land has become available. They tend to be lower quality accommodation as a result. Unlike like the ones I discussed earlier, Sterling Lion, really only one of the properties has a proximity issue, and that line is not as busy as the L'Atelier line. So we think that 5.5% is probably a fair number on that income, and that comes to the value indicated. The other situations to consider are that right now, today, these properties are all owned by the same individual, but they did register easements to allow for access, and an easement is a diminution of rights. So it's a bit of uncertainty down the road. These are all minor issues, but these are the things on page 2 that you've got to investigate all the time. And the inducements on this property haven't ended after, 10 years of occupancy. So that's my case on this one.
Thank you. Cam, any questions?
No questions.
Ian?
No, I don't have any questions. Thank you.
Carrie?
Yes, Mr. Newville, you just mentioned that this property has inducement. Can you expand on that?
Since it was built, it's required, and the assessor provided this information on page 13. It's now in its 7th year, I guess, and the inducements have not ended. You'll see that on his page 13, he indicates a rental incentive of $33,000 and then move-in bonuses of $53,000. If you've got a good project, you're going to need your incentives for your minimum for the first 3 years, and you hope to have them phased out by the 3rd year, and being into the 7th and still having to apply them indicates a property that has some rental problems.
Okay, thank you.
Thank you, and I have no questions. Since we have heard all of the items scheduled today, this hearing is now adjourned. Thank you very much, everyone.
Hey, bye.